Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, here we are. Again, another interesting week in the financial markets. And it's a chance for us to get together with our listeners.
We love answering listener questions. We have a couple today. The first one's from Justin. He says, "Hi, folks. I just read that the Fed is accepting reverse repos, taking cash back up to $1 trillion. Actually, they're taking in $1 trillion a day, Bob, while simultaneously running a quantitative easing scheme of $120 billion a month, which buying assets or debt and printing fresh dollars and giving it back to the banks. I'm so confused. It sounds more like cramming food down a duck's throat to make foie gras. It would be a goose that you do that to.
Yeah.
That makes correct money policy. What is the purpose of this insanity? They're both buying and selling at the same time, again, to the tune of $1 trillion a day.
Well, the left hand doesn't know what the right hand is doing. The theories about central bank intervention have been hopeless from day one, and they noticed that on a business expansion, that credit would expand. So these intellectuals then said, cause and effect, that the expansion of credit causes the increase in business activity. Well, that's the old one, like the rooster crowing in the morning, and that causes the sun to rise. There's various descriptions of that, and it's confusing correlation with causation. And even over in the dreadful Aristotelian logic, it's called a primitive syllogism. So the whole of central bank intrusion by creating credit and pushing it into the market is a hopeless intellectual failure. And then you want to look and see how successful those are. And the idea of pushing credit into the market goes back to the original promoters of the Fed in the early 1900s, when then anybody knew that a severe credit crisis would be followed by a recession. So then the credit fools then imagined that the Fed, as the last lender of last resort, would then rescue a failing company or bank that would prevent the credit crisis that causes the recessions. So since 1913, the tout has been that the Fed would prevent a recession. And including the one that we had last year, there have been 19 official recessions. Now, the one last year is sort of weird and based upon COVID shutdowns and that sort of nonsense. So let's just talk about cyclical recessions, of which the last one ended in 2009. So there's been 18 cyclical recessions, each started by a credit crisis, and each credit crisis followed a great financial boom in the economy and in the financial markets. So, hey, the theory doesn't work, and the more it doesn't work, the harder they apply it. But I think on the next recession, well, first of all, listen, hey, there's going to be a financial crisis. With the kind of speculation that's going on now, that becomes inevitable. And then with a crisis, there'll be a recession. And then this is where I think certain schools of economists could become effectively critical, and the story can get out beyond certain pages. And then the other one is the ordinary folk are going to say, hey, look at you guys, blew trillions of dollars, our taxpayers' money, on trying to prevent a bust. And here we have a bust. So it's going to be nasty, but I think it'll prompt a wave of honest criticism that could become very intense, and it could reform the Federal Reserve from their hopeless theories. Thanks for the question.
Bob, were they right to nickname the Fed the creature from Jekyll Island, because that's where the meeting was held where they created the Fed?
Oh yeah, they had it was a secret, because at the time, early 1900s, there was still a memory of previous U.S. central banks. The Bank of U.S., I think one was called, and they ended in disaster. So the concept of central bank in U.S. had been tried and failed and was known to be a failure. So this is two things. They had secret meetings to make their progress, and then the other was that they couldn't call it a central bank, so they called it the Federal Reserve System, which is all BS anyway. So, often I've quipped, Jim, that financial history itself is a due diligence upon every crackpot theory ever floated in privately in the financial markets or within policy making theories about being able to manage an economy. And then along comes a recession that's going to again disprove the notions about interventionist central banking. And one doesn't want to see a disaster, but one will naturally be delighted to see proper criticism being directed upon the today's policymakers.
Bob, what would the alternative be if we didn't have central banks?
I think that would to not have a central bank, you would then would be just all privately owned commercial and or investment banks and that sort of thing. I think there is a role for a central bank. For about 150 years in England, the Bank of England was responsible. And why was it responsible? Because the sterling was convertible into gold. So this is how the best alternative. You can't get rid of the central banks, but going to gold convertibility. Now this gets very interesting as well, because the economic intruders feel that if you have a central bank on gold, it constrains their ability to create credit when they arbitrarily deem that credit should be created. So, and then of course they tout this by saying they can manage the economy by fiddling around with interest rates and money supply and that sort of stuff. But the whole point of a gold standard is that it limits what a central bank can do. So a gold standard would manage the ambition of central bankers, and managing the ambition of central bankers would be a very constructive thing, I would think. And we can also show that during the long period when England was on a gold standard, that the growth in their economy was absolutely incredible. And a long period of relatively little change in basic prices, hey, it was a good world. And I'm convinced that with a major reform, political reform, that eventually ordinary citizens will enjoy limiting the ambition of central bankers by forcing them to be on a gold standard. It's going to be a nice time. I'm hoping around for it.
A question from Michael. Hi, Jim and Bob. I noticed that margin debt has peaked and the transports are underperforming the Dow. Does this seem like a good place to short if there ever was one? Maybe one starts first with shorting emerging markets, commodities and gold miners, then European stocks, then the Russell, then technology, and finally the S&P. Bob, what are your thoughts on an effective shorting strategy if one was willing to take that risk?
Yeah. Boy, it's a tough game, because there are some very professional traders out there who in a wild market, it always goes a little further than a veteran trader can imagine. So then this becomes part of the problem where some professional traders have shorted the market too early, then they're forced to cover, which adds more bids at the top. So, yeah, there is a time for shorting, and I think for my own account I'm going to wait till certain lines in the sand are taken out. One would be the advanced decline line taking out a previous low, then certain levels on the S&P, that sort of thing. Or after the market's broken, depends on your risk and abilities. But yeah, and sometimes it's very tempting to short the straight up ones, but that can be expensive. And then the other one is a little duller, and that is to short a weak sister. You might consider that as well. Weak sister, yeah, as you mentioned, could be emerging, emerging ETFs or emerging debt, that sort of stuff. So, yeah, there will be definite opportunities on the short side, and even like the great trader Jesse Livermore, if you read about his manipulations in right about now, in 1929, in early September, he knew that Babson was a financial commentator and always bearish. So he realized that Babson was speaking at some important do early in September, and he then got the media onto it, all his traders and everything else, and that first break in the Dow was called the Babson break. But Livermore traded it all the way down. Short, cover, short, all the way down. And then, sad of sad, at the very bottom in 1932, he didn't sense that the very bottom was there and kept playing the short side all the way up, couldn't break his habit, and eventually ended up without any money at all, which was a tragedy because he was a brilliant, brilliant trader and wrote some books on it that are worth reading. But you got to play the market on your own, and you've got some ideas there that are worth following up.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. One of the headlines that caught your eye today, Evergrand shareholder exodus as their electronic vehicle unit drops 27%. What's your take on that story?
Well, we've been following Evergrand. I love the magnificent name. And it's been in trouble. I should have looked it up, but maybe 5 or 6 months. And here we have yet another headline on a developing individual disaster within perhaps the end of a great bull market. And it sort of reminded me, Jim, of in London in 1929, there was a very successful market operator. Hattree was his last name, and he had parlayed from nothing up to quite a wealthy man. And in end of 1928, early 1929, he was putting together a huge merger of steel companies in England. And he thought he had all his financing set up in order to accomplish this, and he was fully committed himself and leveraged. And then as 29 progressed, there were people became apprehensive and stepped out of his financing package, and then eventually he realized he was carrying the whole thing on his own and he couldn't handle it, knew that he was going to fail, and then had, I don't think he actually got in touch personally with the governor of the Bank of England, but had people who knew him get in touch and say that if Hat Tree goes under, it'll take the market with it, and the Bank of England was not going to bail out a private speculator, so it didn't happen. But the market failed anyways, and it would have failed. But for a while in the headlines, the blame was based upon Hat Tree's failure, when he was just one within a whole crowd of failures. So, Jim, I just love financial history.
California is now building emergency backup natural gas power generators to prevent blackouts from when their solar-powered electrical system isn't generating enough. I guess a rainy day or forest fire smoke would shut down those solar plants.
Yeah, and every day after sunset, there's no energy from the sun shining on those solar cells. So, but no, it's interesting because for a long time, I've been writing on climate since 2008, and the idea that this power is free from the sun or from the wind really overwhelms any cost effectiveness. So then you've got California. It used to be practical, innovative on the practical side, and then it went crazy. So with one of the arguments I've been using, Jim, is that with every unit of interruptible power, such as from solar or windmills, you have to have the equivalent backup of power generated by something that doesn't get interrupted. And at the moment, natural gas-fired electrical plants are the most efficient there has ever been. And then, irony of ironies, that California sits still on huge amounts of oil and gas reserves, or with today's modern drilling, new reserves could be established. So this is a mark of reality. They have finally realized that for every unit of interruptible power they put on stream, they have to have the backup of uninterruptible power, which takes us to the point, why bother with the interruptible power in the first place? Just put in what works, and natural gas works very well. I think in a while there will be very efficient nuclear power plants, but the problem is you've got a whole lot of superstitions to deal with on nuclear. But it's a very interesting step that, Jim, we will watch with interest.
Iron ore prices tank as China's steel output slows down. The story?
Yeah. Of course, in the last year, industrial commodity prices, well, first of all, they got zapped down to horrendous lows with the first COVID panic. And then there's been a terrific recovery. Now, how we've been handling the recovery in industrial commodities is that where the intrusion by governments around the world on shutting everything down on the COVID, that was exceptional. But underneath it, ongoing, was the most powerful financial bubble in history. And always with such a bubble, you have a strong economy with the final leg up, which we're getting now. And with that strong economy, you would have a rise in industrial commodity prices. Now, in our history, as far back, I think 1830 or something like that, we got the price of copper. And copper's real price, as deflated by the CPI, has gone up in the final year of a great financial bubble. Going the other way, gold's real price has gone down, and these two have happened. Copper is up, and gold was down. The real price was down worse a few months ago, but it's recovering a little. Now, there's one other thing that is part of this real, where you take interest rates. You got the nominal rate of interest, which is the headline rate, and then you adjust it for inflation, which gives you the real rate. And it's now down to something like -3+%. And some of the interest rate people are getting quite huffed about that. But then in our work on every financial bubble, in the final year, the real price or the real long interest rates in the senior currency drop dramatically. And this one at -3 or whatever it is. There have been two other great bubbles, 1825 and 1772. No, there's a third one, I can't remember, where the real long interest rates in the senior currency did get down to, I think one was -5 and the other was -6. So what we're looking at right now is with the real price of copper up, that happens in the final part of a great bubble. The real price of gold down happens in the final part of a real bubble, and real long interest rates go down in the final part of a bubble. So we're looking for all of these to change, and it will likely happen. So this then reinforces the view we have that the real huge inflation is in financial assets, stocks and junk bonds, and each of the great bubbles in financial assets in the past, history doesn't shift over to a huge inflation in commodities. What happens is that in the post-bubble contraction, prices of most asset classes deflate. So what one wants to look at is that the action in bond prices is bond price inflation. The action in stock markets is stock price inflation. And when that inflation ends, everything deflates. And that is going to be quite interesting because we have had, for this year, the boom in all these wonderful items would likely run to about mid-year, and they have. And then August would see the transition of boom and whatever follows a boom. And yes, things have been changing that say we're on path to a post-bubble contraction, possibly being discovered maybe late September into October. And hey, the thesis is going to be proved in a short while, won't it, Jim?
Mm-hmm. Another headline here, dry bulk shipping rates are soaring. It's supply chain problems there. And I can tell you, I ordered some solar-powered tiki lights from China, and it took so long for them to get here, about 6 months, I think. I forgot all about them. But they are so realistic, Bob, that one night at 11 o'clock at the night, the fire department pounds on our door, and we're 8 floors up in New Westminster, and somebody on the ground thought our balcony was on fire. So these solar-powered tiki lights, I guess, are very realistic. I think they well were worth the 6-month wait, but this wasn't me putting together a car or a truck or a fridge or something that. So is this are the soaring shipping rates, hard to say fast, soaring shipping rates connected to supply shortages as well, and that's inflationary and causing these prices to soar?
Yeah. This is due to two things. The artificial shutdown occurring within a fabulous global boom. So all of a sudden, and I have one of our subscribers heads up a consulting firm in the engineering of assembly lines for cars. And I get some terrific stories from him. And there are shortages of chips like you wouldn't believe. And I talked to him just last week. He phoned and he was all excited because he says that he has sometimes positioned certain items within the construction of cars, including chips, and he says he's got some and he's selling them at good prices, but he says there's absolutely zero out there. There are real shortages. And again, we don't know if it would be as tight without the artificial shutdown of everything. I doubt it. You would have had high prices for industrial commodities and all kinds of items. Now, whether you would have had as severe shortages, I don't know. I doubt it. You could have had some shortages, but this thing was shutting the world down for COVID. That is a huge part of the problem, but I think this will ease rather quickly with when the credit crisis starts. And all I can say, Jim, now is that what's been happening in August so far suggests that we are on the path to a credit contraction.
Bob, thank you so much for chatting with us.
Well, Jim, good to be with you, and look forward to next week.
Bob loves answering your questions. If you have any for him, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.